phenomenon, and not just a trend contained within a specific sector of the economy. If the three averages are going in the same direction, or at least two of the three averages are going in the same direction as the theory suggests, it's a good indication that the economy as a whole is going in the same direction. Notice that the third principle of confirmation, in alignment with the second principle of trend identification, gives a framework to analyze if there is a reversal signal and a confirmation in the financial markets as a whole. The fourth principle in the Dow theory is that volume confirms the trend. As a general guideline, volume increases at the peak of a bull market and at the panic phase of a bear market. Once again, for a more detailed study of volume, check out the Ultimate Beginner's Guide to Volume Trading in the video card. In basic terms, the idea that volume confirms price movement suggests that high volume confirms the strength of the price movement and low volume disproves it. For example, if price is rising and volume is increasing, the price movement is confirmed. If price is rising and volume is flat or even declining, it means that the upward price move might not be as strong as it seems because there is not much volume to sustain it. The same is also true for downward movements as well. If price is falling and volume is rising, the downward price movement is confirmed. If price is falling and volume is flat or declining, it means that the downward price move is not as strong as it seems to be, since there is not much volume to back it up. Traders need to pay attention regarding this sort of thing because volume is an indicator of market activity and not market direction. So when volume is rising, for example, it doesn't necessarily mean that price is rising. It might be falling as well. The fifth principle in the Dow theory is that only closing prices are taken into account. Charles Dow believed that the closing price was the most important of the four prices, which are open, high, low, and close. That's because many different types of traders execute orders near the close. For example, day traders close all their positions near the close, and some hedge funds execute orders near the close as well. Closing prices alone tend to be easier to analyze because traders will not make any judgment about what happened inside each period. Even though it's easier to analyze, a lot of important information is omitted when only closing prices are taken into account. In modern price action analysis, using the four prices contained in a candlestick or bar is a pivotal part of the process, as there are many nuances buried in the relationship between the four prices. For example, by analyzing the ratios between the four prices in a single candlestick, we can roll back the internal history of the period and we can make better judgments about the intentions of buyers and sellers. The sixth and final principle of the Dow theory is that the trend persists. In other words, a trend is assumed to continue in effect until a reversal signal is confirmed. The Dow theory makes no assumption about how much a trend should last, unlike other theories out there, but it states that trades should be taken with the trend, and the trend only ends when there is a clear reversal signal aligned with a confirmation given the rules already laid out in the course. One thing that becomes clear while using the Dow theory is that it's much easier to apply it in a bull market because bull markets tend to last longer and they have lower volatility, which makes the signal and confirmation a little more reliable. Bear markets are usually shorter in time duration and the movements are too volatile. By the time the bear market signals are confirmed, the market might already be too developed. In this chart, we can see an example of that. During the 2008 financial crisis, the bear market lasted about 516 days. The next signal and confirmation for the bull market that came later happened arguably in 2010, and this bull market had been sustaining itself until the 2020 coronavirus pandemic hit the markets. The market took 1,461 days to recover and come back to the top again since the lowest point of the 2008 financial crisis. Notice how the bull market has lower volatility and longer time duration. These are the 6 fundamental principles behind the Dow theory. Let's make a brief summary of them. The first principle claims that stock averages discount everything except what Charles Dow used to call acts of God. The second principle is about trend identification. A bull market happens when the primary trend, which is the largest and slowest price movement, shows rising prices, and a bear market happens when the primary trend shows falling prices. Beyond that, A bull market shows three distinct phases called accumulation, increasing volume, and final explosive movement. A bear market also has three distinct phases, and they are called distribution, panic, and lack of buying interest. A bullish reversal signal happens when the market is going down and price breaks the last swing high. A bearish reversal signal happens when the market is going up and price breaks the last swing low. Both of these signals are only confirmed when prices reverse 20% from their extremes in absolute terms. The third principle states that for a trend to exist, at least two of the three Dow Jones averages must be going in the same direction. The fourth principle states that volume confirms the trend, so when volume increases, we have a strong price movement, and when volume decreases, we have a weak price movement. The fifth principle states that only closing prices should be used in the analysis, since that's the most relevant price among the open, high, low, and close according to the Dow theory. The sixth and final principle is that the trend persists until there is a new reversal signal in alignment with a confirmation of the signal. Now we must move on to what I consider to be the most important section of this course, which is the analysis of the advantages and disadvantages of the Dow theory. This is important because most trading educators will often highlight the advantages of some technique or method and ignore the disadvantages as if they were absent. However, for a proper and fair learning experience, you should become aware of the limitations in any technique or method. In fact, the most value you can extract out of common trading methodologies comes from the understanding of their inherent limitations. We'll start by quickly reviewing the advantages of the Dow theory, and then we'll attack the many disadvantages present in the method. The first advantage in the Dow theory is that it's based on investor psychology that does make a lot of sense, even though it's not very sophisticated. The phases of a bull and bear markets can indeed be observed over and over again, and they do represent the cycle of emotions that usually appears in the markets. The second advantage is that volume analysis that is aligned with the simple investor psychology also makes sense. The simple premise that volume confirms price movement also seems to be an effective tool in all phases of bull and bear markets, and its alignment with the various phases of bull and bear markets also makes sense. The good thing about volume is that it is devoid of lag. The third advantage relates to the fact that the Dow theory makes no assumption about how much a trend should last. Some theories like the Elliott wave theory, for example, make bold assumptions about how many waves a trend should have and the ratios between the various waves. The Dow theory is a much looser method. It assumes that the trend can persist until there is a clear reversal and confirmation signal. That is a much simpler and much more effective way of thinking because it lets the market show when it's time to update the analysis and not the other way around. Theories that try to box the market into a rigid set of rules tend to be ineffective. The fourth and final advantage of the Dow theory is that it is extremely simple to use. The method has gained fame for its simplicity, even though this tells us nothing about the effectiveness of the techniques involved. Just because something is simple doesn't mean it's good. There are no complicated concepts in the Dow theory, and that makes it easier for beginners to study its features. As far as advantages go, these are the most relevant. Notice that the advantages are very broad and general, which is not a very good sign. We must now move on to the disadvantages, which are more numerous and unfortunately highly specific. I say that this is unfortunate because the more specific the disadvantages, the greater the probability that they will go unnoticed by most people. Most of the disadvantages of the Dow theory are related to the chart analysis part of the method. As we just saw in the advantages, the part related to investor psychology and volume analysis in the theory does make sense even though it lacks profound concepts. However, the chart analysis part of the theory is indeed very flawed and quite superficial. Let's begin first by talking about the problem of identifying secondary swing highs and lows, which is a prerequisite for the detection of reversal signals. Secondary swings are similar to waves in the simple analogy made earlier. The problem is that the secondary swings vary a lot in size and time duration, and that makes it difficult to select the right swings in real time for the detection of reversal signals. There are secondary swings that are quite small, and they could almost be mistaken by daily fluctuations. Other secondary swings, on the other hand, are quite large. Even though the Dow theory is simple, identifying the correct secondary swing highs and lows for the reversal signal involves quite a bit of discretion, and the theory doesn't expand on how the trader should approach this type of discretion in great detail. This leads us directly to the second disadvantage, which is the trade-off between the secondary swing size and the accuracy of the reversal signal. Larger secondary swings are easier to see, but because they are larger, they also provide reversal signals that are far from the actual reversal point of the market. Smaller secondary swings are harder to see because they can be confused with daily fluctuations, but on the other hand, they can provide a more accurate reversal signal. Speaking of inaccuracy, the Dow theory provides the simplistic swing breakout as a reversal signal. Swing breakouts are the most inaccurate type of breakout signal because they are too obvious. Even traders who open price charts for the first time can intuitively use swing breakouts as a technique without knowing it is a technique. It's usually one of the first intuitions that occur when traders open a price chart, and that is precisely what makes it bad. In more technical terms, the swing breakout is a bad idea because it completely disregards the idea of supply and demand trading. When the price breaks a swing high or a swing low, the market has already extended itself past the optimal reversal point. Ideally, traders should wait for a retracement near the last significant supply or demand zone. If you want to learn more about supply and demand trading, check the Ultimate Beginner's Guide to Supply and Demand Trading in the YouTube card. One of the strongest pieces of evidence against the use of swing breakouts as a reversal signal lie in a situation called expanding pivot formation.